Welcome back. We have reached the final class in our Fund Accounting Basics series. So far, we have learned what a fund is, who is involved, how money moves, how transactions are recorded, what the fund administrator does, and how the numbers are reviewed. Now we are looking at the final result of that entire process: fund reports. Let's quickly recap the journey we have taken through this series. We began by understanding what a fund is and why fund accounting is different. Then we identified the key parties involved, followed the movement of money, and learned what fund accounting records in practice. After that, we reviewed simple booking examples, the role of the fund administrator, and how the numbers are checked. Today, we bring everything together by looking at how recorded and reviewed information becomes reports. Recorded activity becomes reviewed numbers, and reviewed numbers become reports. Why do fund reports exist? Fund accounting can contain many transactions, balances, and calculations, but investors and fund teams need that information presented in a way they can understand and use. Reports help explain what the fund owns, how the investments performed, how much each investor contributed, how much each investor received, and what each investor's current position is. They also show what changed during the reporting period. So reports turn accounting numbers into useful financial information. Fund reports are read by different people, and each reader may focus on something different. Limited partners usually want to know how their investment is performing. The GP or fund manager may focus on the performance of the fund as a whole. Directors may review whether the fund's records and reporting appear reasonable. Auditors use the reports and supporting records during their independent review. Regulators may look at whether reporting requirements are being met, while management may focus on matters that require attention or action. The same fund information can therefore serve different users for different purposes. A fund may produce several types of reports. These can include an investor capital account statement, a NAV report, financial statements, an investment or portfolio report, and management reports. The fund may also issue capital call notices and distribution notices when money needs to move between the fund and its investors. There may also be audit reports and supporting schedules. Not every fund uses exactly the same format or produces the same package of reports, but the main purpose is similar: to explain the fund's financial activity, value, and investor positions. Fund reporting can generally be viewed from two levels. The first is fund-level reporting. This shows the fund as one complete entity, including total investments, cash, liabilities, income, expenses, and total NAV. The second is investor-level reporting. This shows the position of one individual limited partner, including capital contributed, distributions received, their share of profit or loss, and their ending capital balance or NAV. So fund-level reports explain the whole fund, while investor-level reports explain each investor's share of that fund. Now let's understand an NAV from the point of view of an investor's capital account statement. For the investor, NAV represents the ending value of their interest in the fund at a particular date. We begin with the investor's opening capital balance. Then we adjust it for capital activity, such as contributions and distributions. We also include the investor's share of investment performance, including income, expenses, gains, and losses. After all of these movements are combined, we arrive at the investor's ending capital balance, which may also be presented as their NAV. So the simple logic is beginning capital plus capital activity plus investment performance equals ending capital balance, or NAV. Let's look at a simple capital account statement. The investor begins the period with a capital balance of $500,000. During the period, they contribute another $100,000. They are allocated $50,000 as their share of the fund's profit. They also receive a distribution of $30,000, and $5,000 of fees or expenses are allocated to them. After including all of these movements, the investor's ending capital balance, or NAV, is $615,000. The statement therefore explains how the investor moved from the beginning balance to the ending NAV. A simple way to read a capital account statement is to divide it into two main sections. The first section is capital activity. This shows money moving between the investor and the fund, such as capital contributions, capital calls paid, distributions, transfers, or redemptions. The second section is investment performance. This shows how the investor's share of the fund performed, including investment income, realized or unrealized gains and losses, fees, and expenses. When we combine the beginning balance, capital activity, and investment performance, we arrive at the ending capital balance, or NAV. Capital activity explains money moving in and out. Investment performance explains how the value changed. It is important not to confuse commitment with capital balance, or NAV. An investor may commit $1 million to the fund. The fund may have called $600,000 and the investor may have contributed that $600,000. But the investor's ending capital balance may be $650,000. Why is it different from the amount contributed? Because the ending balance also reflects profit or loss, investment gains or losses, distributions, fees, expenses, and other activity. Commitment is the amount the investor promised to provide. NAV is the investor's current recorded position in the fund. Some fund reports explain completed activity, while others communicate upcoming cash movements. A capital call notice tells the investor how much money to send, when the payment is due, the relevant bank details, the purpose of the call, and the remaining commitment. A distribution notice tells the investor how much they will receive, why the distribution is being made, the payment date, how it affects their capital account, and the recipient bank details. These notices are practical documents because they explain exactly what cash movement is expected and how it relates to the investor's position. Another common report is the investment or portfolio report. This report explains where the fund's money is invested and how those investments performed. It may show the name and type of each investment, the purchase cost, the current value, and any increase or decrease in value. It may also show how much each investment represents as a percentage of the fund, any income generated, and purchases or sales completed during the period. This report helps users understand what the fund owns and what is driving its investment performance. The fund's financial statements provide the formal financial picture of the fund. The statement of financial position shows the fund's assets, liabilities, and NAV. At the fund level, NAV can be understood as total assets minus total liabilities. The statement of operations shows income, expenses, and investment gains or losses. The statement of changes in partners' capital explains how investor capital changed during the period. The cash flow statement shows how cash moved, while the notes provide additional explanations and accounting information. Together, these statements support and explain the fund's reported financial position and NAV. Although these reports have different names, they should all tell the same overall story. The portfolio report supports the value of the investments. The financial statements show the fund's assets, liabilities, income, and expenses. The NAV report calculates the fund's net value. Capital account statements allocate the fund's activity and results to individual investors. Capital call and distribution notices explain cash movements between the fund and its investors. Each report provides a different view, but all of them are connected to the same underlying fund activity. Let's finish by bringing the complete fund accounting journey together. Investors provide capital, and the fund carries out transactions. Fund accounting records those activities. The balances are then reconciled and reviewed. Income, expenses, and investment performance are allocated, and ending capital balances and NAV are calculated. Reports are then prepared for investors, fund teams, and other users. So the main takeaway from this final class is simple. A fund report explains what happened, how the fund performed, and what belongs to each investor. And with that, we have completed the Fund Accounting Basics series from beginning to end. If you liked this series, please do not forget to comment, like, and subscribe. This will let me know that fund accounting is a topic you would like more content on.